see it at the pump, you see it at the fuse box, and now the shipping patterns are all
Hi, I'm Justin Bergner. I'm an analyst and portfolio manager at Gabelli Funds. I'm focused on diversified industrial and transport names. So I want to talk about the railcar stocks. The railcar stocks are principally railcar lessor GATX, railcar manufacturer and lessor Trinity Industries, and railcar manufacturer Greenbrier companies, along with railcar equipment suppliers like Wabtec and Knorr-Bremse. Our firm has long had an interest in the lessors with a large position in GATX and smaller positions in Trinity Industries and Greenbrier, although we don't lose sight of the other names. The June quarter was very good stock performance-wise for the railcar manufacturers and the lessors, with GATX up 19%, Trinity up 6%, and Greenbrier up 34%. Much of the quarterly move was in response to Greenbrier's earnings on June 29th, which sent its shares up 32% that day, while lifting Trinity's shares 6% and GATX's shares 3%. Greenbrier's move was in large part due to self-help, as the company is having rapid success in reducing costs as part of its recently articulated 50 to 55 million cost out goal by 2025, mainly driven by insourcing of fabrication. Easing supply chain dynamics were also a tailwind. Third, industry dynamics are quite strong despite ongoing negative railcar carload growth. Greenbrier generated orders for 7,900 cars in the month of June compared to second quarter deliveries of 6,400 cars, and after a few quarters of lackluster orders. There were several large orders for near-term deliveries. Heavy scrappage of cars in recent years, along with a low number of rail cars in storage, underpinned by weak railcar productivity, has led to supply-side tightness. This has led to increased lease rates in prior quarters and now higher railcar orders, with a lower steel price likely a catalyst to spur orders in June. So why did Trinity's stock price increase only modestly in the second quarter? Trinity continues to struggle operationally on the manufacturing side, both in terms of managing supply chain challenges and having trained labor to support the rail car shipment ramp from its plant in Mexico. While easing supply chain challenges should be helpful, and Trinity is moving to insource some fabrication as well, its operational performance has been spotty. GATX has a 50-50 joint venture with Rolls-Royce for aircraft engine leasing and now owns some engines on a 100% basis, also serviced by the joint venture. Increasing international air travel bodes well for the engine leasing operations as they are mainly wide-body engines. Each stock has its pros and cons, but GATX is the company with the best operations and capital allocation, which has allowed it to accrete value over the long run despite a relatively full valuation. Trinity is undervalued as EPS metrics miss the value of its younger leasing fleet. Still, manufacturing challenges have limited earnings and cash flow, and the company has struggled to run its leasing and manufacturing operations well when external conditions become more challenging. Greenbrier is a relatively good operator, but is principally a manufacturer. It trades at a cheap multiple, but there is a demand headwind from new cars being able to handle larger volumes than the cars being retired. Rail car productivity may also improve from today's low levels, allowing today's fleet to carry more carloads, although new safety regulations could be an offset. So overall, a more tepid outlook for railcar manufacturing than for leasing operations.